if we look back at the end of the year, if Bitcoin has dipped into like, the upper 30s, or if it's already six figures, neither of those scenarios would surprise me because it's such a volatile asset and there's so much marginal difference that can happen. But that's why instead I've been far more comfortable making 2 year outlooks, which is that I really don't know what's going to happen in 2024, but at least I feel like I have a higher conviction of what's going to happen with the combination of 2024, 2025. So you absolutely could have a case where all these people are super bulled up for 2024, and maybe what they expect to happen doesn't, it gets all shifted back 6 to 12 months, for example.
Lyn Alden is a renowned investment strategist whose expertise in macroeconomic trends has guided investors through the complexities of the global financial landscape. Lyn combines her engineering background with a deep, analytical approach to offer unique insights into how economic cycles, monetary policy, and global events influence investment opportunities. In this episode, we'll explore the pressing issues facing today's economies, discuss potential future scenarios, and unpack what this all means for individual investors and the broader financial system. Whether you're looking to understand the impact of recent policy changes or you're seeking strategies to navigate the current economic climate, Lyn's analysis will provide valuable clarity. So get ready to enhance your understanding of macroeconomics with one of the best in the business. Before we get on with the video, we'd like to introduce our sponsor, Stampseed. Follow the link in our description below for 15% off your stamping kit. Furthermore, 77% of our viewers on this channel are not yet subscribed. If you are enjoying this content and want to support our efforts, please hit that subscribe button and help our videos find more people. Without further ado, here is Lyn Alden on the Coin Stories podcast.
If you look at the first 3 quarters of 2022, that's when you had the full force of the tightening. So the rates were going up, the balance sheet was going down at the Federal Reserve, and the Treasury and the fiscal side was not really offsetting it at all. So it was just, assets across the board were down, everything was down, the economy was decelerating by almost all metrics. But starting in that kind of fourth quarter of the year, that's when you started to get the Treasury offsetting the Fed. So first they began dumping their Treasury general account cash back into the market, which is pro-liquidity. And they continue doing that all the way up through May of last year, 2023. And then the second lever they pulled was to start issuing more short duration bonds than long duration bonds. And that allowed them to pull capital out of the reverse repo facility and push that back into the market. And so the Treasury's done two different types of actions that have more than offset the Fed's liquidity drain. And so that's been beneficial for both US markets and to some extent global markets because it took the edge off the dollar index. And as you know, there's a lot of global debt denominated in dollars. And so when the dollar strengthens relative to other currencies, a lot of those companies get squeezed. You don't want your income to be in the weak currency and your debts to be in the strong currency. But ever since that exact moment, that fourth quarter of last year, we saw the dollar index kind of come off its highs, which then gave the globe kind of some breathing room. So that was a big factor. And then two, the interest rates were interesting because that was surprising. I would say one is that there's just so much liquidity in the system, so much extra cash still in there, that it kind of gives a lot of buffer to get through it. And two, it's the fact that the kind of the middle class, upper middle class homeowners have a lot of that debt is fixed rate, mortgage debt kind of fixed rate. Investment grade corporations, again, a lot of that's low fixed rate. So very little of that has actually impacted these entities. Mostly it's felt in small businesses, which use shorter duration bank loans normally, non-investment grade corporations, so junk rated corporations that generally have shorter duration debt, people that rely on credit cards. So, working class and kind of lower working class, they're more impacted, unfortunately, by some of these policies. And then ironically, the federal government itself has pretty short duration debt, on average, something like 6 years. But a lot of that's like front loaded in the first year or two. And then they have a long tail that goes out to 30 years. And so they're actual centers in that first few years. So they start exploding out interest expense. And what a lot of people don't realize is that interest expense, all these deficits on the federal side are someone else's surplus.
Mm.
So they could be flowing into offshore investors that own the treasury debt. They're flowing into onshore investors that have money markets, that have T-bill exposure. Kind of, any sort of mid-duration bond or lower is doing pretty well. There's been a re-increase in the wealth effect from equity prices and real estate prices kind of bouncing back on a nationwide average. Um, and so that was kind of a big factor for how we were able to get through that. And again, the challenge was, if you asked a lot of people in early 2022, including me, can they raise to 5% and it not, kind of blow things up? We would have said, oh, probably not. But I think the key is that you respond to information early when it starts to happen. You say, okay, what is happening that I didn't necessarily predict, and what is the sequence of events playing out? And so it was important to be to kind of move with that as it happened. It's kind of, I keep pointing to the 1940s as the closest analog, and that while that has been incredibly useful, it doesn't mean it's going to play out step by step, note by note like that. So you have to I find that having that historical analog, but then month after month, quarter after quarter, updating what's actually happening is kind of that blend it's hard to do, but it's something that we all have to do. I don't see any signs that Bitcoin is not going to continue to be correlated with liquidity. So I think one of the biggest challenges, everyone's kind of focused on the halving and things like that. And of course, that all matters. So the ETFs matter, the halving matters. The halving doesn't necessarily matter in the several months around the halving. You know, Bitcoin's ongoing hardening is really important. But if you look at prior bull runs, there's a lot of variability around the halving. And I would say in large part that's because it's actually liquidity that affected the timing more than just the halving. The halving helps set up higher highs and higher lows because it's how much Bitcoin's coming to the market that has to be absorbed, especially in a bear market,
Hmm.
really matters. But the actual timing, three months, 6 months, 12 months, is, in my opinion, far more liquidity driven. So um, I think the ETFs are going to be helpful. Um, People are debating whether or not they're a sell the news event. Like, a lot of people priced in the ETFs, and is
Hmm.
is the first quarter underwhelming? It's certainly possible. That money doesn't just pour in as quickly as people think. One thing I would take the under on is people keep saying, well, what if these tens of trillions of dollars of pools of capital have a 5% allocation, for example, or 3% allocation, and it's like that's not going to happen anytime soon, most likely. One kind of description I've given is that it's been known for a while that if you have a gold slice in your otherwise 60/40 stock bond portfolio, it improves your risk adjusted returns because there are periods of time where both stocks and bonds don't do well, but gold does well. So, for example, the 2000s decade or the 1970s decade, um, there are decades where just that slice helps a lot, and yet it's still underallocated compared to what you'd expect from looking at those numbers. Now,
Mm.
Bitcoin is like a rocket fuel version. I mean, if you look at
Yeah.
that, Nakamoto portfolio or other types of resources that show what is adding a small slice of Bitcoin to your portfolio do, and it's like astounding for risk
Yeah.
adjusted returns. So it should, you'd think it would catch on quicker, but some traditional pools of capital just take a long time to make investment decisions. Generally, when someone, a small business where the owner just has majority stake, they can make very swift decisions. There's some publicly traded companies that are still a lot of the decisions still held by the founder. For example, MicroStrategy.
Today's video is sponsored by Stampseed. Don't store your Bitcoin in cold storage without stamping your seed phrase on an indestructible titanium plate. Stampseed is fireproof, rust-proof, impact-proof, and easy to hide. It has no loose parts and will give you ultimate peace of mind that your Bitcoin is safe and sound for the long term. Click the link in the description below for 15% off your stamping kit. Welcome to Bit Intelligence. We are committed to bringing you top-notch Bitcoin-only content. Subscribe to our channel and hit that bell icon. Okay, back to the video.
They're able to
Hmm.
make quicker, more decisive type of decisions because they have that capability. Whereas, you know, firms that have a lot more spread out decision making, it can be a very long time to actually meaningfully adjust a portfolio strategy. So I do think that the ETFs are going to be helpful, maybe less so than people expect right away, but I'm hopeful. I think the other thing that could potentially derail it is a liquidity problem in 2024 or a stagnation in liquidity. It doesn't have to be a liquidity crisis, but it could be. that you have just another stagnant liquidity situation. So you have like 6 months of choppy liquidity, choppy Bitcoin, and it kind of lets out some of that consensus steam, and then maybe you run in 2025, right?
Mm.
So I'm not trying to predict any of those scenarios. Like literally, if we look back at the end of the year, if Bitcoin has dipped into like the upper 30s, or if it's already six figures, neither of those scenarios would surprise me because it's such a volatile asset and there's so much marginal difference that can happen. But that's why instead I've been far more comfortable making 2 year outlooks, which is that I really don't know what's going to happen in 2024, but at least I feel like I have a higher conviction of what's going to happen with the combination of 2024, 2025. So you absolutely could have a case where all these people are super bulled up for 2024, and maybe what they expect to happen doesn't, it gets all shifted back 6 to 12 months, for example. I think there's a lot of scenarios like that. So far, we've not really seen any sign of distribution. So, when Bitcoin goes through, kind of major bull runs, normally some of those older holders start to sell into that market strength. Maybe they want to rebalance, maybe they want to consume, now they can finally afford the house they wanted that they couldn't afford before. And so you see some of that distribution as new buyers come in. And
Yeah.
that process hasn't even started yet based on any sort of on-chain analysis you look at. So I still think we're very early in this structural bull run, but I do think it's important not to take a bull run for granted. It's not necessarily like owed to you just because the halving's happening or just because it's on that cycle. Now, I think it's probably still likely over the next 2 years, but it is important to kind of manage your expectations and risk accordingly.
With a keen eye on historical analogues and a pragmatic approach to forecasting, Lyn's insights offer valuable clarity amidst uncertainty. Stay tuned for more enlightening discussions, and remember to subscribe for the latest recaps, insights, and films about all things Bitcoin. If you want to watch another one of our podcast recaps, try this one. Here, we'll see you next time.